let's have a look at some of the slides that I prepared for you today to give us a better view of what's happening in the market. So in looking at what the market has done so far, I looked at the performance of several markets across the world in comparison with what we've had. And if you look at the year-to-date performance of the PSEi index that you can see here on the lower right part of your screen, we're still quite negative. We're down about 3.25%. That's against relatively good advances you see from the S&P, the world index, which conspires to be able to look at a big portion of the world markets together. The emerging market fund also up about 9%, and China is doing about up 6.24%. Now, it might really look that we are a laggard, and so far we are, but if you were to look at what happened in the Philippines just in the span of the last month or so, you could see that the Philippines seem to have tried to be able to play a catch-up game with most of the other markets. If we managed to be able to pick up about 9% in that one last month, and that is the reason why we're only down about 3%, because we were down quite heavier from that situation. Now, if you're wondering why we're really laggard, well, of course, we talked about this last time, in that the influences of the pandemic really hit us hard, and the ability for us to be able to recoup from that was really very much in question. We are still looking at the vaccination rates to be able to gradually pick up across time, and hopefully by the end of the year that we may be able to get a certain level of confidence that a good chunk of society has been vaccinated, if not maybe towards the first quarter of next year. And I think that's what's happening and why we've managed to be able to recover well. And a reopening play is finally at our door, and we hope to be able to see more for this moving forward. Now, looking into the structure of the market in terms of Asia, you would see the Philippine index is here, portrayed here right in the middle. And if you notice on the upper part of the lines, you'll see the Japanese market, Shanghai market, and Hang Seng. And you would notice that the markets you see over here, they seem to have been rallying as well, but they seem to be tapering off right now. Some of them are just tapering only maybe in the last few days, such as us, and perhaps in India, in Thailand. But the other markets have already started to be able to bank sideways, if not lower. So given the conditions that we have, it looks like we're going to see a coordinated effort over here to make corrections of especially for those countries that manage to be able to swing a bit too much. And we're going to have to prepare for that. But the nice thing I'd like to talk about is that despite that little correction, it was nice to see that we've broken down trend lines, which I will show you later, and that should remain to be quite positive for us moving forward. So let's have a look first at the US, because of course this is the main market and may continue to generate some ripples to other markets as well. With regards to the US market, we've noticed that quite a bit of volatility seems to be coming in just recently. And the Dow we saw relatively weaker, pulled back for the last couple of days. The S&P also did the same, but perhaps not so much, while the Nasdaq was still the stronger bet, and even last night managed to be able to show a relatively good rally, almost coming closer to 1%. However, it is being challenged by its previous high. Now, one thing that worries me, though, is that momentum in the S&P 500, which looks at about 500 issues, seems to be slowing down. And because of that, that might be able to yank down on the speed of which that uptrend is taking place, or may be pushing it into a more sideways type of motion, similar to what happened to the Dow Jones, which it currently is going sideways. So we might see some rotational movement in the US market as well. Maybe the basic traditional issues may feel some pressure. However, some of the tech and growth companies seem to be doing okay. And I think you probably will see a split of activity in the US. But we have to be open that there are some momentum slowing signs, and that could engage some corrections relatively soon. So we just have to be very watchful of that. But I think the longer term impact of the US still is okay into an advance, and perhaps after a correction, we might see some resounding moves again from the US market. Now, some of the things that they've been talking about recently is really about looking at bond yields in terms of interest rates, and of course, inflation in the US. And just recently, they've come out with a 5% inflation rate, which is the highest we've seen since 2008 in the US. And that caused a bit of commotion because people are quite worried that they might see runaway inflation, given the economic vibrance that they've been seeing into the US. However, the Fed governor has managed to be able to try to allay fears about that, and has been telling us that this inflation signs that we're seeing is only going to be transitory, and that means it's not going to be too much lasting. And perhaps if you look at the bond yields that you see here on the left side, you can see after a very aggressive stand that lasted till about maybe March towards the end, the beginning of April, it started to be able to come down a bit, gradually, forming a consolidation pattern into that particular channel that you see into my screen today. And the nice thing about that is it tells us that they don't seem to be worried about any more or much inflation. And if it's showing you that channel correction, that tells you that it seems to be smoothing out, and the fears of that may not be lasting as well. And I use this as an advanced indicator telling me that although, yes, we've been seeing the signs of inflation have been quite high, this also tells me that it's being downplayed now, and that should be able to take out some of that risk. Another indicator I've been also looking at recently is the CRB index that you see here on the right side. The CRB index is simply an index that measures the value of a basket of commodities. And in particular, oil is heavily weighted into this particular index, but you do have quite a number of different commodities included in this list. And one thing I see in my technicals, and I see a divergence warning taking place. And a divergence is simply a situation where you're seeing a higher high being made in the price of the index. However, in the RSI, you're seeing a lower high. And that tells me that the momentum of this upward move has slowed down. In fact, before yesterday's big decline into the commodity index, I was already looking at this divergence and was saying, oh, I think this is it. We're probably seeing a temporary top into commodities. So if we are, that means that it would also contribute to the fact that inflation may not be a threat, because if commodity prices start either easing, going sideways, or if not going down, then that should be able to remove some of that threat of that inflationary scare that we've been seeing as well. So the clear line situation now is that if you see the picture I have here on the left side, which shows the dollar index, the dollar index responded quite well to that announcement of the Fed that they may be raising interest rates 2 years from today. I know you might say 2023 is still a far distance, but people weren't talking about rates going up, and they were worried that inflation may need to be able to push it in the short term. But at least you've seen that they will do it. However, it still takes some time before you can come around to be able to have that type of expectation. And the consequence of that was the dollar became quite strong, because it itself said since inflation is not going to be too much of a threat, then the value of the dollar can renew itself. And this is the reason why we saw some good rallies into the dollar. However, I'm seeing that the dollar is hitting my first target areas, second target areas closer to about 91, 94, and the index, which generates about a 61.8% Fibonacci rally. And if you can manage to be able to pull up from here, the next resistance zone I'd be watching after 91, 94 would be something closer to 92.50. And then if that is still very strong, then it'll probably go all the way back up to the previous high. But I think let's take it one step at a time. It's currently at resistance and maybe a little bit more. Let's see if it managed to be able to continue on with that. Now, because of the strength into the dollar, the Philippine peso has taken a bit of a back step. So the picture of the peso dollar here on the right, you can see that the peso dollar has shown a very, very large rally in about a week, last week's time. And that's primarily because what you've seen here in the dollar has become strong, so the peso became a little bit weaker. And this is the reason why you've seen that the peso made that type of adjustment. But the peso dollar rate is also hitting an area where I expect some resistance, and I've tagged that between 48.45 to about 48.75, and we hit the first target already. If it's going to stretch out a bit more, I think maybe up to here, and that's where I put in the 48.75 area. After that, I would expect that we'll probably enter another consolidation phase first for the Philippine peso. Now, in looking at the local side, if inflation was a threat into the other market, are we seeing similar conditions here? I'll start first here with my chart on the right side. If you notice, Philippine inflation has been relatively muted. We've been doing about a 4.5% inflation rate for the last couple of months. And hopefully we can just hold that or maybe even pull back just slightly. So that will be able to give us some improvement. And in reaction to that, if you notice our bond yields, our 10-year bond yield here on the left side, after coming to a high of something closer to about 4.7% sometime in March, we managed to be able to pull back relatively well, falling to a low of about 3.75% and maybe just rallying now to about 3.91%. This is good because at least it shows you that this push up in interest rates has finally normalized itself, and we're seeing now a more of a corrective aspect, so we won't see too much of a threat into interest rates going up too much as well. Now, it's okay in a reviving economy for interest rates to climb up at a very graduated pace. So I wouldn't expect this to go all the way back down to where it is, where it came from, back late last year. What I would want is for this to just continue to correcting, maybe go sideways. If it wants to push up, it will need to be able to see vibrancy first in the economy, and maybe we'll probably see that maybe sometime already next year. Now, last time we spoke in our expert huddle, we talked about the corrective situation as well into the Philippine index, and I was looking at the potential A, B, and C swing coming out from this index, and I laid out 3 zones to be able to look out for. The first was at 6,440. At that time, we would already hit it. The next zone, which I was more comfortable to be able to see, was about 6,250, which would also be the extension of this channel zone that you see here at that time. And of course, if things went really bad, then it would probably go to 6,000 or lower, which I said this is a very small chance of happening given that condition. So what was nice is that we've actually made that corrective movement or C wave, and we completed that. I'll show that to you in the next chart. And the estimated support target that I gave on about 6,250, it surpassed it a little bit, but it went about 6,150 before we saw a bottom, and that's good as long as we don't go back to 6,000 or lower. And I said that only a push above the downtrend line or the 20 or 50-day EMAs can overturn our corrective wave. And I'll show you in a little while that that's what happened. And I said after that, we're going to see a rebound, which is what we're seeing now, and then perhaps a consolidation, and then the market will come to reverse its reactive trend. So given the market today, this is what our index looks like. So this is where we were last time we spoke, and this is that extra C wave that we've come in to be able to show you where the market hitting that low point of about 6,150, and sometime towards the end of May, coming towards the beginning of June, we saw our index break out of this corrective area pattern. And to me, this was a very significant finding because this ends the corrective wave, at least this corrective trend we've been seeing then, and managed to be able to push the market up quite handsomely. The first part of the rally, as Marvin pointed out, was really generated as what we believe to be short covering. Short by whom, you might ask? Well, we feel that perhaps there could have been some foreign players who were trying to be able to maintain their very bearish stand into the Philippine market. And it was them who probably kept themselves in a short position and had no choice but to be able to cover it once they saw that the rally in the Philippines was coming out relatively strong. So a rally by the locals meeting short covering by the foreign equals the monumental rally that we've seen in recent weeks. Now, it's okay to have that short covering maybe for a few days, maybe about a week. But after that, the shorts perhaps would be lying low already. And now we're seeing renewed buying coming into the market. And that's what took the market roughly above 6.6, maybe to where we were closer to about 6.9 or 7,000 when we hit that on an intraday period. However, we are now hitting an area of resistance that I think we have to be a bit cautious about. This is a range between 6,867 and about 7,100. This is the first zone of resistance that I feel is quite strong. And because of this, I feel that the market condition may be warranted in terms of another short-term corrective pullback. Also, we have an overbought situation. Our RSI was hitting about 72%. You can see my indicator here in the bottom showing that a clear high point in your RSI band was being hit. And an overbought market means that you've seen a very short-term advance in the price, giving a lot of people the opportunity to be able to take some profit. And it's because of that that we're probably going to see some choppiness right now in this corrective aspect that I was talking about. And for those who have not been able to participate in the earlier rally, this is perhaps what you're waiting for, an opportunity to get back into this maneuver. But since the market is coming from an overbought period, we just wait a little bit. I think the market may be able to try to dribble itself down. I hope the range that it can tag would be closer to about maybe 6,745 to about 6,626. And I hope it can hold there, because if it can do that and generate a higher low, then that could be a good incentive for people to come back and allow the rally to let itself test and maybe chop around, and if not, try to be able to rally back into the next zone of resistance, which I will look next to be between 7,300 to about 7,400. Now, you might want to know where we are into the Elliott wave cycle. Last time we also did talk about this. And if you noticed, I was telling you last time that I felt that the major ABC or corrective wave has been done. And we saw the tail end of that in the March drop that we saw last year because of the influence of the pandemic. And we went through a mini bear market at that moment. If you'd like to call it mini, but it was quite big, from almost 9,000 all the way back down to about 4,750. And after that rebound that we saw there, the market has been being quite volatile, but still generally onto an upward trend. And although the main trend, if you see above here, still has a downtrend line that still has to be broken, I think we are really in a bullish phase, or at least the early part of a bullish phase. And this is why we've seen the index manage to be a good recovery. But it has one more hurdle to be able to accomplish that for us to be able to confirm my suspicion about the bullishness of our market. Now, looking at this in a much shorter fashion, this is the ABC that I drawn out over here. So the bearish phase seems to have been done. We are now in the bullish phase. And on a mini count into the Elliott, I've counted us in being a 1, 2, 3, 4, coming to the fifth wave, which is where we are right now. And as we're building into a fifth wave, this entire move from the bottom of this C to where we are currently is actually, or could be, the first part of a major bull market, or the wave one of a bull market. Now, it might sound good, but remember, there are 5 waves to this. And after you finish the first wave, there will be another corrective wave that will come in, a big wave 2. And that will come off after the fifth wave ends itself. And that's why, it's very significant for us to be able to see if we can go back to that 73 or 7,400 area, if not try to break it before we start coming down. Because if we don't make a new high here, then that will put us back into wider consolidation, which I'd rather not see. But so far, so good. The elements are very much in place that we look like the bullish wave can continue. We just have to be able to stomach some short-term overbought measures, and things should be able to rectify itself after prices pull back and rewind themselves. Now, quite a time ago, I was looking at the German DAX model to be able to try to pinpoint where we are into the cyclical aspects of where prices are. And I'd like to compare this again. In the DAX model, we've come from a basing condition. This was a stronger market, and it actually made its ABC on a sideways movement as compared to us. Let me show you what we did. So our ABC was more of a corrective channel, or a wedge like you see over here, rather than a sideways movement that you see here. And because of that difference, that means our market is less forceful than what you're seeing in the DAX model. But the cyclical factor should still manage to be able to push through. After the ABC, a nice big rally managed to come. After our ABC, so far, a nice big rally managed to come. But now let's just follow the cycle path and see what happens. After the initial part of a rally, here comes a sideways motion of a market that in this case lasted for a few months, in order to be able to give time for a breathing spot from this very aggressive swing motion. And I don't have what happened hereafter, but normally what happened hereafter, as I recall, this market still managed to be able to go up even further. So what might happen here is that our market, since it's not as strong as this, may also attempt to be able to pull back into a consolidation, attempt to rewind and pull itself out of that overbought condition, fix that situation, and then manage to be able to give people another opening to be able to enter our market. So looking into different subsectors, because you might want to see which sector seems to be leading or lagging, or which ones are doing better or not, so that you can try to refocus your perceptions on which issues to be able to look into next. Now, given the sectors that I have over here, right now the strongest was actually on the services sub-index. But to tell you frankly, the only reason why we have this here was really because the incredibly strong movement being taken place by ICTS. There was, of course, contribution by Pure Gold, although PLDT and Globe were not really too much of a contributor because they've been very much a laggard into in this market, and Globe is still trying to base. PLDT is in a rally channel. In fact, it's even trying to threaten support right now. So it's really the recovery of ICT and Pure Gold that helped the services market come in. Now, if you notice in my chart, I listed out the top 5 companies inside the sub-index that show the heaviest market cap into them. And I've emboldened the ones in dark green as the issues that contributed to that sub-index recovery. The reason I'm doing this is because when you see that the market attempts to pull back, you might ask yourself, which company should I be concentrating on? And I want you to be able to look for the companies that are showing underlying strength. Although they may not have pulled back so much yet, but when they do, these are the companies that I want you to be able to focus for a potential buyback inside. So for example, let's go into the next sector, financials. You can see BDO, BPI, Metrobank, Security Bank, and Union Bank being the top 5. And the first 3 did contribute to the upside of that particular movement. I colored BDO, BPI, and Metrobank in green. So if you see corrections into this particular type of stocks, pullbacks to next levels of support is something that you want to be able to look for as potential buyback into these particular companies. So the same goes for the commercial industrials. We have URC, Meralco, Jollibee, Aboitiz Power, and Emperador. Of that, it's URC, Jollibee, and Aboitiz Power that contributed much to the advance. So concentrate on those 3. In the mining, it was really only Semirara that really helped. The rest, not so much. I'm a bit worried about the mining sector right now because I did point out to you earlier on that the CRB index in the US may attempt to make a wider corrective movement. Included in there are commodity prices like mining type of commodities, so gold, copper, nickel, all included in terms of their softening. So I'm a little worried that that pulls back, that could put some pressure into the mining sector. I know some of you have been trying to focus on that because of the announcements of the government, but maybe we might have to wait a little bit longer to see if that can generate more recovery. Right now, it looks in the short term a bit toppish, and you might want to be able to have a pullback in them. It's only Semirara that looks very different from the rest. Finally, we have the property and holdings companies. In the property sector, the 3 contributors, SM Prime, Ayala Land, and MegaWorld. And on the holdings, we have JG Summit, Ayala Core, and Aboitiz Equity Ventures. SM still neutral, didn't contribute as much as the rest yet, but since it's one of the market big caps inside, you also want to keep your eye on it. And right now you can see compared to the ones on top, the ones in the bottom seem to be lagging in terms of the recovery factor. So if you would ask me where I would concentrate on, I'd concentrate on the first 3 sectors that you have above here. And if I don't really have anything else, and these ones start to look good, then I would shift some investments into the other ones that I've seen here below. So in summary of that, so the good telling over here is the PSEi came out of a very rough spot already, and to me that's very good news. We're out of our corrective trend and we're now swung back into a recovery situation. So in the short term, we only have a problem because market prices zoomed up a bit too much, precipitated by the short covering, and of course the new buying we're seeing on the local front. That's generating overbought warnings, and the proximity to our next resistance closer to 7,100, and of course some headwinds which could come in from other markets across the world, which would be from the US and parts of Asia, that might drive some corrective need into that short term. So like I said, for those who didn't get to participate earlier on, you might have the ability to be able to buy back into this pullback. So use that as an opportunity for yourself. Support areas have identified between 6,745 or 6,750, roughly to about 6,626 or 6,630, just to be able to round them off. Also, in those pullbacks, I would highly suggest this. Please lean on the stronger trending stocks. And what I mean is, there's a tendency for people when they're looking into the stock market and they see a few stocks start to be able to push up already. And the tendency for them is to look around them and said, oh, wow, medyo naiwanan na ako. I didn't get to be able to buy at a good price. And they will say, I will look for something that has not moved yet, right? And you're starting going to be looking, and what you're going to be doing is you're going to bring your quality assessment down so that you can pick stocks that have not moved yet. So you're automatically thinking that those weaker stocks will perform just like those stronger stocks. And I'm sorry, I don't think that not all of them will do that. In fact, majority of them will not, because they're lagging for an issue, right? And that issue, although we still have to determine, it could be a case of the pandemic, it could be very localized on the company itself. Until you can see good evidence that they're resounding, I would suggest that I would put my money into where pullbacks are showing from these stronger trending stocks, because they're more likely to continue that strength later on when the recovery comes. So please keep that in good mind. Pullbacks to the 20 and 50-day EMAs are what we're looking for these strong issues. And also keep in mind that we want to be able to put ourselves back into this market and reposition after this profit taking. Okay, so don't be too scared of the market first. I don't believe that it's probably just going to run away, leave us behind. So give the opportunity for you to see these reactions and look for these entry spots, mark them down as they come closer to support. Maybe you can set your gradual buying conditions for that already. And keep in mind that our next resistance targets first after 7,100 will be the 73 to 7,400 range. To me, that's essential. If we can break that, that confirms my suspicion of a trend reversal, and we'll probably see much more viable upside after those resistance prices are actually broken. Now, I prepared a list here of the index stocks. This list over here, I just want to be able to show you how some issues are currently at a situation that they really need to correct. So for example, if you see the list here the list of majority of the short-term uptrends are listed here. First, the 13 stocks of our index are here. I wanted to show you that some of them, like for example, AEV, BDO, JG Summit, Pure Gold, some of them are actually standing between 6%, 4%, or 6% away from their short-term support. And even on their 50-day moving average, some of them are, quite strikingly far from them already, 9%, 8%, 8%. And that to me highlights the short-term risk factor here. So I put that in there so that you can see why the market needs to correct. They need to narrow. The price of this stock needs to come closer to their support moving averages, which is either this one or this one. Right now, some of them are a bit too far. So be careful just attacking any of these strong issues right now, because they need to be able to either wind up in one of two ways. Either they go sideways and wind, or they pull back and make a reaction back to support. Either one of those two can fix the overbought condition and prepare you for a new opportunity. Stick with the uptrends and the strong ones. Now, if you're going to go down to the next level, we have the sideways issues. So you've got issues like from AGI, AP, all the way back down to PLDT that I have here. These are fine. I wouldn't say they're as good as the first one, but these issues, some of them may be able to break out of their ranges and generate a good upside for you. Particularly some of the banks that you see in there look pretty decent. But some of the others are trying to be able to break out, like MPI is at resistance. Metrobank and BPI also have to break out from resistance. So we have a few issues there that they still have to be able to deal with. Of course, the downtrends are Bloomberry. We've got MegaWorld and RHI. So I know MegaWorld may be coming out with the IPO on its REITs. When that is, we'll see. But right now, the trend is not looking too good yet. I hope it can generate a good base information before too long so that it can try to improve itself. But again, stick with the uptrends for the meantime. Now, for some of those people who don't really, are a bit wanting more than simply index stocks, I've lined up 8, maybe 9 issues here that you might also want to have a look at. These guys, I call them the new kids on the block, and these could provide extra kickers for you, especially when these guys correct and give you an opportunity to buy them at a much healthier price. So we have ASEN, we have All HC, ARITS, CNPF, Converge, DNL, Manila Water, Wilcon, and of course, I will add the new IPO Monde. I did not include it in the table because Monde just listed an IPO, and it's very hard for me to provide the moving average values here because it hasn't traded that long as of yet. If some of you are wondering why I put Manila Water there, because they've been listed for quite a long time, well, there was a change in management in Manila Water, and I feel very strongly that that could work out to its benefit. And recently, we've been seeing quite good amount of following on the stock. So again, you can look at these, but again, look at some of them. Their percentage difference to short-term moving average are quite striking. So maybe we want to be able to wait for pullbacks with some of them, especially those that are come to close to being double digits in distance already. So wait for corrections. It'll be healthy for them, but opportunities for you to be able to get into these things. So what I anticipate from the market to make these types of corrections, we've just seen this particular type of movement. We're currently somewhere over here. Okay, and if you see, this is the kind of pullback that we want. We want to see prices come back down, maybe make a recovery, and then build off an area pattern like this as prices come back to their 20 or 50-day EMAs. For the maybe those that are not so strong, they may go all the way back down to their 50-day exponential moving average, which is this one's in red. And again, after that, usually complete it. If you notice in my graph, you have a small a, B, C, a small a, B, C, and that completes the potential correction that they want to see. Now, it's quite possible that you get some issues that may actually extend their advances despite the correction that you're seeing. In fact, they could do something like this. In other words, after showing this correction, they zoom back up and they actually make a new high. It's quite possible some of the stronger stocks can do that. I mean, for example, ICTS was very, very strong today. For example, ACN also tried to make a recovery because of potential index inclusion that could maybe work out for them. And you might have some extensions, but I feel after this next push, you will still need to make that correction. So just be very wary. If you're going to be jumping back on the bandwagon for those types, you might just get caught into the corrective tug that might come after that. We need this to rewind. So don't be too gung-ho in buying too aggressive positions in them. Now, in some of the weaker ones, you could have a bit weaker of a situation that can come out. Instead of going all the way up to the 50-day moving average, the weaker ones could go all the way back down to the 100-day EMA, which is this green line that you see here. So what I want you to do is, if it breaks through the 50-day moving average and it comes back down, try to wait for a double bottom base. For example, something like this. Okay, so don't just buy it in the first push because it could just slide off there. Wait for the recovery, do a retest of the low. When you see that little W-like formation, that's the formation you want to see, and that tells you that more likely that you're seeing already a bottoming aspect of that correction, and this might be a good time for you to be able to kick in. If you're buying these ones, a break of their trend line, the red trend line you see here, that should be able to give you a good thumbs up that it's time for you guys to be able to enter already. So just to give an example of the situation we have today, here's BDO. So look at this very, very aggressive swing that it's done. Why? Because it broke out through this 105 resistance that it had, and it just shot up very, very quickly after being depressed for such a long time. But the stock went up very, very quickly. Overbought, the level started to flare with your RSI going over 70%. And in the last 2 days, we've seen a profit-taking wave. Here's an example of why the market needs to breathe in. Remember, this is not the end of the move. This is just it's overbought, and it needs to be able to pause and regain some strength. And the best way for it to regain strength is to wind up. And that's what it's going to be doing over here. And you can see that here are the short-term moving average. Your 20 and 50-day are way down here. Your price was all the way up here at 1750. And so this difference is what it's going to try to narrow. So the closer it can get to these two, the better for you, because that will reduce the risk that you have. So I'm going to show you an example of that. So if you're looking at this situation, for example, here in CNPF, you will see now a condition over here. So pretend that this movement here in BDO is this area of CNPF then. Again, very, very sharp. Moving average is way down here, showing big spreads. And look at the correction that it had to do. It pulled back, made a counter rally, then continued its corrective movement. So when you see this kind of movement, just draw that line I was telling you, just follow a reactive trend line here. And once this finishes and rebounds off that, and the trade comes back, and you'll probably get a renewed move back to buy CNPF. So again, temporary overbought condition, waiting for that correction, an opportunity for those people who want to be able to look into it, buy it gradually as you come closer or you see rebounds of support, either this one or this one, and you should be okay to be able to flesh yourself out into the next swing. So I hope that I've managed to be able to give you a good account of where we are into the market. I think the worst is over for now, but it doesn't mean that we're not going to have volatility. We will, because the market is overbought. And given that condition, we're here to prepare for a temporary correction into our market, wait for it to settle down closer to support, and a rebound of your supportive area should be able to present your opportunity to be able to buy stronger trending stocks, not the laggards, and concentrate on that being your new motive for this new trading strategy that we have.